Good afternoon. I have 2 or 3 announcements before we get underway. You can guess what they are. One is, again, for photographic purposes, among other things, you want to take all beverages off your table and all computers off your table and any bags. It looks like they're already all gone. So that we get what look like academic pictures when we're shooting here. And so that's first thing. The second is, if you're an MSRE and we're going low tech. Since Tim isn't here with his computer, we're doing low tech attendance. And so if you didn't get a form, wave me down or catch me at the end and you can fill one out. Okay. So that's the announcements, I believe, and now to the fun of it. I'm really pleased to be able to introduce our guest for this time. She's been a friend of ours for a long time, and I don't know why we didn't think of asking her to come before this year, but we finally did, and she graciously agreed. So it's my pleasure to introduce Mary Pat Dunleavy, Senior Vice President of Fidelity National Title Insurance. She's a Gator grad and who has done good. She's been in the title insurance industry her entire career, I believe, since she left us here, and has found her way up through the ranks and is now oversees administration, underwriting, and sales for all of Central Florida for Fidelity National Title Insurance, which is really a composite of several well-known names: Chicago Title, Commonwealth Land Title, Fidelity National Title, Lawyers Title, and Ticor. It's that together, the group is the 293rd ranked company on the Fortune 500. And so they're a big deal. They're the biggest title insurance organization in the world. And so she runs oversees their Central Florida organization, which has got to be one of the most active. She's a member of many important industry organizations. I give you the list, but I want to give her the time. And is particularly active, though, in 2. She's a leader in an organization that I have a high regard for, which is Crew Network, Commercial Real Estate Women, and is playing a big role there in Central Florida and beyond. And she's also a member of our Bergstrom Advisory Board, where she's currently on our executive committee, and we're mighty glad to have her. And we're mighty glad to welcome her today to talk to us about her work. Welcome.
Thank you very much, Dr. Archer, Dr. Ling, Tim, Nikki, Pam, Denise, everybody for having me here today. Dr. Malone just met. I know this is the one you've been waiting for. I know title insurance was it's put it at the end of the year, so it's so well worth the wait. How many of you, when you were little, thought about, this is the career I want, I'm interested in it? Raise your hands. I don't have my distance vision glasses on, so I'm assuming everyone's hand is raised. I will tell you, I did not either, but I hope by the end of this you'll at least consider it as a career opportunity, and I will do my best to let you know what a great world title insurance is. So first I'm going to tell you a little bit about me, and I apologize to some of you who were in the discussion earlier because it may be a little redundant, but hopefully not. It's a little disheartening when you boil yourself down to just words. But I figured for purposes of remembering things, I could just do it this way. So I'm from Michigan. I'm the youngest of 7. When I was a freshman in high school, my father traveled for nuclear power plants and ended up on a power plant in Fort Pierce. So I was living with my brother at the time. He was like 3 older than I was. My parents thought it sounded like I was having too much fun. They were right. And so I moved to Florida with them when I was a freshman and went to high school in Fort Pierce. I fell in love with a boy who was going to school here in Florida. I was going to go to another college outside of Florida, but I was in love, so decided I was going to stay in the state. He turned out to be a loser. He decided it was okay to have 2 girlfriends. I didn't think that was okay, so that relationship didn't work out. I came here. I met a fantastic Irish boy named Kevin Dunleavy, which redeemed myself in my parents' eyes for not going where they wanted me to go to college, even though this this ended up being, they thought, the perfect choice for me. While I was here, I managed apartment complexes and kind of fell into it. I started being an RA, like at a dorm, but in an apartment complex. Does anybody know the apartment complex across from Tiger, what it's called? It's brand new. What that's called now? It's white, and it's got blue on it and tan. What is it? Okay, that used to be the Place years ago, and then it was Gainesville Garden Townhouses. So I started as an assistant manager, then became manager, then went out to Treehouse Village and managed Treehouse Village all the time while I was going to school. I changed my major several times and kept thinking about different opportunities. I wasn't sure what I wanted to do, but I was a better employee than I was a student. So I finally just decided I needed to get out. So I graduated with a degree in English, thought briefly about law school, but also remembered that I was a better employee than I was a student, so decided law school was probably a bad idea. And I started interviewing with companies here at the job fair at Florida. The economy back then was very good. So I had 3 offers, but only one of them in Orlando where I wanted to move. So I got a job with the Gap in retail management. I started out making $14,000 a year at the Gap as an assistant manager in the tiniest store in Orlando, and in 9 months, I was making $27,000 at the Florida Mall store, which was the biggest store in Orlando. So it was a great progression, but it was a job I hated. And I was working nights and weekends and holidays, and I was newly married, and I couldn't stand it. So I ended up, I was home one day, and my husband was circling things in the newspaper. They were, again, good job market back then. He was circling things, and he circled something that said, enthusiastic and energetic, positive. I can't remember all the other attributes, and he said it was a sales field position with an expense account and a company car. And he said, this is you, this is your job, this is the one. I said, no, I'm not enthusiastic. I was so beaten down by my role at the Gap. I said, no, that's not me, I can't do any of that. And he goes, we just have to go talk to them and interview. So that was 30 years ago. That job was at Commonwealth Land Title Insurance. I didn't know anything about it. When I walked in the door, I didn't even know what they did. I can tell you it took me about a year to even figure that out. But I got the job. I ended up at Commonwealth for 10 years, and I've been at Fidelity for 20 years. And it is the most fantastic decision that I ever made. And it's a career most people only stumble into. So that's why I'm very, very glad that you guys are sitting here today hearing about it, because more people should make it as a choice, not find it by accident. So all ended well with title insurance. I have 2 boys and 2 dogs, and life is very good for me. So what we're not going to do today is we're not going to talk about cap rates, because I really don't care about it. We're not going to talk about analyzing debt ratios. We're not going to boil the ocean. And by that, what I mean is title insurance is very complicated, and we could certainly go down a lot of different roads and get in the weeds. And I think unless you all took no-dos today, you might not want to go along on that journey. So we're not going to boil the ocean today. I'm going to try to give you a feel for it. And we're not going to get bored. I promise you I'm going to try my best to not bore you today with my presentation. What we are going to do is we're going to learn about building wealth. Title insurance is one of the cornerstones of wealth building in the United States, and I think it's not talked about enough why that is and what we do. We're going to discover a hidden gem of a career, like I mentioned. We're going to hear some juicy stories. Some of the things that happen in our industry are, again, pretty interesting. Most of those I'll talk about at the end of the presentation, because some of those stories are not publicized by our company, or some of them are ongoing claim situations that we're in. And I want you guys to feel free to ask questions. I have a distance vision problem, so if you raise your hand, just move it around a lot so I can see it. And it's fine to ask anything that you want. The questions that came out of the earlier session today were great. And some things that I didn't even think to incorporate into my presentation, so I'll try to weave them in as we go. I love this phrase from Scott Adams. If there are no stupid questions, then what kind of questions do stupid people ask? Do they get smart just in time to ask questions? I say that just because it's funny and I put it in. Of course there are stupid questions, and I might give you a stupid answer, but if you have a question, ask it. because for most people, they don't know anything about title insurance, so somebody else is probably wondering it too, and actually it's probably going to be valuable for everybody. So, we are here. Welcome to Florida. This is an interesting slide because I don't know if you all know this, but when there's a named hurricane and it gets put in a box with hurricane winds out 100 miles from anywhere in that box, we aren't allowed to close a transaction in Florida. So this becomes our nemesis. Once it's named, it's just a matter of time before all over the state, wherever it's going to move, we have to shut down all our operations and everyone has to wait it out. So what is title insurance? Title insurance protects the financial interest of the owner or lender of real property. It protects against loss resulting from title defects, claims, encumbrances, and other matters. It's different than other insurances, and it's widely misunderstood a lot of times by regulators because of these two things. It's a one-time payment. You pay it when you close on your real estate transaction, and you never pay another premium for the title insurance. It's also the only insurance that insures everything behind the date of the insurance. There's no go-forward coverage. It is a coverage for everything that has already happened. So, in the history of title insurance, the system of conveying property in the United States was well established and was, I would say, a pretty sound system for transferring and identifying what people owned. But there was no way to safely or securely convey that transaction or insure that transaction until the first title company in 1876 was formed, and that was a predecessor to the company that we now own called Commonwealth. There's a book that I brought, and you can tell I like it because I've got like 25 Post-it notes on it, called The Mystery of Capital by Hernando de Soto. This book is, I mean, it's actually, for me, it's a riveting read. For you guys, it might not be quite so riveting. But it talks about why the insured transaction in our country changes the way we are able to start businesses, buy other properties. I've got a quote from him next. So, the substantial increase of capital in the West over the past 2 centuries is the consequence of gradually improving property systems, which allowed economic agents to discover and realize the potential in their assets, or the growth or the equity in their assets, and thus to be in a position to produce non-inflationary money with which to finance and generate additional production. So, other countries don't have title insurance. We insure in other U.S. territories, but we were talking earlier, Puerto Rico is very complicated for us right now because you can't insure something unless you go physically look at it. Is it there? What's happened to it? We used to recently insure in the Caribbean. We no longer insure in the Caribbean as of about 9 months ago because there's too much risk. And the countries that, well, everywhere else that doesn't have title insurance, it's because, in our opinion or our assessment, we can't safely identify that you own it. We can't identify that there's no other heirs, that this is the geographic property that you own, but we can do that here because our system is so established and adopted uniformly nationwide. So in countries where they don't have title insurance, they may have wealth, but they can't build their wealth. Their capital is dead. And so when your capital is dead, you can't use the equity in your home to take a loan out and start a company, to take a loan out and buy more real estate. So the very fact that we insure the asset here, the insurable nature of our real estate drives the investment. It also drives a lot of foreign investment to the U.S. I know a lot of times people think that people from Brazil come to South Florida and buy property because the values are so good. Well, in some respects that's part of it, but it's also safer for them to spend their money here because they're going to get an insured product. And so that allows them to feel comfortable with the investment in the United States. So there's 2 types of title insurance policies. One is an owner's policy and the other is a loan policy. The owner's policy, as I mentioned earlier, protects the owner of record against losses incurred due to any title defects that existed prior to the purchase of the home. And the loan policy protects the lender's interest and lien position for the monies being loaned. So, for example, on the loan policy, let's say it's a second mortgage that you're closing on. So that lender needs to know that they are in second lien position on that property and that there's a first mortgage ahead of them. On the owner's title insurance policy, you're insuring that owner that, one, they are clearly getting title to the property. There's no other parties in possession of the property, nobody else who has an ownership interest. There's no liens against the property that they don't know about, unpaid taxes, child support liens, anything else. So those two types of policies are what we give. I'm going to go through a list of just, and we won't drill down in any of them, but just things that can go wrong and why an owner's policy is important. And I did tell them earlier today a story, and I'll try to summarize it briefly here. Some people in Dixie County bought 20 acres of property for $100,000. And the Dixie County Recorder's Office did not properly record an IRS tax lien of $300,000 against that property. The people bought an owner's policy for $100,000 and a loan policy for $100,000 when they closed the transaction. They went on to build a $250,000 home on the property. The IRS knocked on their door and said, we have a $300,000 lien against your property, against the prior seller that wasn't disclosed because it was misindexed in the courthouse, so the title company didn't find it, and the IRS said, we want the money. They immediately called the title insurer at the time. It was not our company, it was another company, but they called and said, okay, we need to be reimbursed for the $300,000. We have a loss. And the title company wrote a check for $100,000 because those insureds did not get an owner's title policy when they built the $250,000 house. So they had $100,000 of coverage. The title company paid the $100,000. There's really no way for the title company to go back and recover that because we don't go and recover from government offices. We don't make claims against them. So the $100,000 check was written, and the people still had an incredible lien on their house and a problem. So the next list of things are owner's title policy matters that can happen and why it's important to get an owner's title policy. So forgery of a document, fraud in the execution of a deed or other document, undue influence over the grantor of a deed, false impersonation by someone purporting to be the owner, undisclosed or missing heirs, wills not properly probated, mental incompetence of a grantor of a deed, heirs born after the execution of a will, incorrect legal descriptions, that happens all the time, deeds executed under expired or false powers of attorney, confusion due to similar or identical names. Imagine doing a title search on someone named John Smith or someone named Jorge Rodriguez in Dade County. What happens when you get the liens or judgments against a common name, you have just miles and miles of records to go through to figure out if this is your seller. Incorrect indexing of land records. Clerical errors in recording legal documents. So what happens in a transaction when you've gone to and in Florida, every state has a little bit different, a different way of doing title insurance. It's regulated state to state. We in Florida have either title companies, so it would be like ABC Title Company, or law firms that can close real estate transactions. When you go to them to say, we have agreed, I'm going to buy this property, this is the seller, they will contact us and we'll put a title commitment together for that transaction. The title commitment is made up of 3 parts. Schedule A is the specific information about the parties to the transaction and the property and the amount involved. B are the B1 are the requirements that we require before we insure that property. So for example, pay off the seller's mortgage to Wells Fargo. The exceptions are the things that we accept out. We are not covering the matters on the B2 exceptions page. So Schedule A, as I said, it has the effective date. And remember that that's the date that the coverage ends. So that date is everything behind it. Before that date is what we're covering. So the effective date means prior matters are covered. Owner's policy amount and proposed insured, loan policy amount and proposed insured. So that would be the proposed insured on the owners could be Mary Pat Dunleavy. The proposed insured on the loan policy could be, again, Wells Fargo. Vesting information is who is going to, who's the seller, basically. Where is it coming from? And then the legal description obviously speaks for itself. This is what a Schedule A looks like. It's really hard for you guys to see, but it's got all that really pertinent information specific to this transaction. The B1 requirements, I told you, allows, it's basically a roadmap to the law firm or title company to close the transaction. Everything that they need to do according to us for us to insure it. The B2 has, it may have matters related to, that are not shown on a survey. So we may put a standard exception on there that says if you don't have a survey that is, in our opinion, is within a reasonable amount of time or is done by an ALTA certified land surveyor, we may come back and say we're not going to certify any losses due to the survey. So these standard exceptions go on that page. And then as people, if we have a problem with the survey, maybe they'll say, okay, we'll go get a new one. Well, that's fine. Then we might remove that exception on the commitment. So what happens is after all of those things are taken care of, the requirements and the exceptions, then the closing agent is ready to close the transaction. They close the transaction, all the money gets dispersed to the appropriate parties. Then they issue the final owner's policy and the final loan policy on an underwriter's paper. So I say this, and I use the size matters, kind of that cheeky phrase. There was a situation that I got called about probably 4 years ago. And it's kind of embarrassing, I'm telling on myself. An attorney at a law firm in Winter Park called me and said he had a $20 million transaction by a builder. And they had requested an underwriter he was not familiar with. And in Florida, there are probably maybe 13 underwriters doing business. To be an underwriter in Florida, you need roughly $5 million, I think, of reserves. You need to be in business 5 years in another state. You need certain levels of qualified people. But there are a lot of underwriters in Florida that are smaller. And so he had not heard of them. I kind of told him who they were, and I did know about them. And he said, well, what are their reserves? I said, well, I have no idea. I mean, they're pretty small, but I don't know what their reserves are. I knew what ours were, but I didn't know what anybody else's was. So I said, I'll find out. Let me go find out for you. He called me back about 3 hours later, and he said, I found out. I went and found out what their reserves are. That company had $6-ish million in reserves. He said, I should be disbarred if I wrote my client's transaction on a company that had that amount of reserves. And he said, and frankly, you should have known that. And he was right, because as a person out there in the industry, that distinguishes my company dramatically from competitors, and I wasn't knowledgeable about it. I knew, basically I knew us and no one else. So this next slide is what we call policyholder surplus. So this is the amount in reserves as of a frozen moment in time, and I want to say this is probably Q2 this year, I would think. So the blue line is the company I work for. Almost $2 billion in reserves. The next line is Brand X. Well, I'll say their name because I was telling people earlier. We only reinsure a transaction, meaning in Florida, for example, the state will tell you how much you can insure on one transaction. And then a lot of times underwriters will impose a limit below that because they don't want to take as much risk. So let's say the transaction is $1 billion and you're us and you can insure $767 million. Then that difference, we're going to go out in the marketplace and have other companies insure behind us to get to the $1 billion. We only reinsure on First American. We will we will only reinsure First American. We will not reinsure any other companies because of really this. So the red line is First American, who's another very robust underwriter. And then you can see there's two others that are still pretty significant, and then these guys. And I'm not trying to knock them, but I'm just saying the size of a transaction when it's really, really big, this matters. And I'll give you a good example of it. If you're the beneficiary of a life insurance policy, do you want that policy written on a company because the person who bought the policy knew the person who was selling it and they thought they were really nice? Or do you want the policy written on a company that has the money behind it to pay it? And so as as our company has become big and little companies have popped up now that the market's more robust, the knock we get in the market is, oh, Fidelity's so big. You probably can't even find anybody there you know. Oh, they're so big. And so we now have stopped apologizing for being big. As an industry, as an insurer, title insurance underwriters should be big. We should be big. We should have a lot of reserves in the bank. And so those of us that are bigger are living up to our fiduciary responsibility to our insureds. So I say yes, we pay claims. There's always that thing out there that insurance companies don't really pay claims, and that's not true. We pay a lot of claims. So the number one type of loss, several years ago it was fraud and forgery, and I talked about that a little bit earlier, and I'll tell you some stories later. But the number one type of loss for us today is search and exam, and that's 23.5% of our claims payments. So what happens, and again, this varies state to state. Nationwide, there are 1,100 employees on the agency side of the company that I work for, and total, there's about 21,000. What happens is, Florida has 400 employees on the agency side. The reason we have so many is in the state of Florida, we do the search, which means we go to the title records and we look for the tax history of the property. We look for liens and judgments against the owners. And we are searching all the public records. Then we examine the documents to make sure that the notary was acknowledged properly, that everything was acknowledged and done properly. So nationwide, a lot of times the companies are responsible for their own search and exam. However, we still may end up paying some claims on that, even if it's their own work. So when you do it collectively and you look at the risk out there, this category, because of human error largely, is the biggest. Sometimes it's misindexed, like the story I told you. That can happen, but more often than not, it's somebody missed something. So I want to tell you, I've got this story to read. This was a situation where a homeowners association restrictions were missed. And this was a very specific claim. So a young couple saved to purchase their first home. The home was in a beautiful subdivision. The home was located on a golf course. They made an offer and the seller accepted. Somewhere during the time the contract was accepted and the closing, the homeowners association recorded a new deed restriction against the property. The restriction stated only persons over the age of 65 could reside in the subdivision. Obviously in Florida, this is not unusual. The seller never disclosed this to the buyers. Unfortunately, title also missed the new restriction. That could have happened one of two ways. It could have just been human error and been legitimately missed, or it could have been missed because it was, the title search can only go up to so many days before the closing because of the public records. And if that was recorded after that, it's called the gap between the date the closing happens and the date the public records comes up to the closing date. There's always a little gap. Sometimes it's bigger. And it could have been recorded in the gap. So the transaction closed. We insured the buyers. We insured the lender. Shortly after the couple moved in, the HOA welcome wagon stopped by to welcome the new homeowners. It was clear that this young couple was much younger than the new age restriction, or I said had a really good moisturizer and were looking really good for 65. But I think they figured out that the reality was probably that they were not 65. The HOA sent them a notice which included a copy of the new restriction and gave them a deadline to move out. Husband filed a claim with the title insurer. Our claims attorney contacted the husband, made arrangements to put the house back on the market, pay the moving expenses, and work on finding them a comparable home. Everything was all agreed upon. The husband explained, I guess the husband and wife were having conversations about it. She loved the home and didn't want to move. She contacted our claims attorney and said it was their dream home. They'd saved, they'd looked forever, they wanted this home. So under the provisions of a title insurance policy, we have autonomy to remedy a situation however we see fit. So sometimes it's not just writing somebody a check. Sometimes it's a matter of, is there a creative way to make everybody whole or as whole as possible and happy? So that's what happened in this one. After listening to the story from the wife, the claims attorney chose to resolve this in a different manner. She contacted the HOA and worked with them to get a variance for these specific homeowners, allowing them to stay and live in the property while they owned it. She made arrangements with the couple to make up for the loss of marketability they'd have when they would go to sell their home, because now their pool of buyers was only people over 65. And then she went back to the sellers of the property who failed to disclose the restriction and worked out a settlement with them because we were obviously going to sue them for our loss. So there's some creative solutions out there, but our job is to make everybody whole and then and hopefully get to the other side of the transaction without a lot of unhappy individuals. So the next slide is I hope you can see it. So on the left, you have data security, which is firewalls, encryption, antivirus software. And then on the other side, you have Dave, human error. So this is probably our biggest threat right now because you guys know that criminals are out there trying to get really creative on how to breach legal systems. The title insurance industry was kind of a sleeping opportunity. You know, everybody knew banks had money. Nobody knew how much money was in escrow accounts at law firms and title companies. They've now figured that out. And we still have that person in our world. And 92% of all breaches are preventable. They're all human error. And these breaches are significant and expensive. And we are, as an industry, I told you fraud and forgery were the biggest claims in probably like 2008 maybe. We've got it down to number 2, but I don't think it's going to stay there. I think it's going to go back up to number 1. I was telling the group earlier, the situation that's happening constantly right now, probably weekly or daily, is hackers will get in through usually realtors' Gmail and Hotmail systems. And while they're in there, they'll watch the transaction. They'll time it just right, usually at the end of the month when everybody's rushing and under stress. And they will imitate a party to the transaction's email and ask usually for the funds to be wired to a different bank account. Now, has anybody here ever worked at a title company? Escrow, anybody escrow, worked in escrow? So what happens is the instructions are usually agreed upon very early about where the money is going to go when the transaction closes. But then what happens is things are changing all the time. Oh, I said Wells Fargo, I want it to go to B of A. So things are moving all the time. So it's not unusual for title companies to get repeated requests to change something. Obviously, criminals have figured that out. So what they're doing now is waiting until people are frantic. They're inserting new wiring instructions, and the money's going somewhere else. And it's significant. It's happening all the time. So that's fraud and forgery. The third most common area of claims for us are settlement procedures. That's almost 13%. Settlement procedures are everything that's not related to the title. So that's the closing itself. So that's the money was dispersed improperly. That's the all the documents weren't properly signed. I asked earlier if anybody had bought. Does anybody own a piece of real estate here? Okay. So were you amazed when you closed on it how many pages you had to sign? You thought 150 pages. Is anybody in here in law school? Well, then I can really say it. You had to sign 150 pages because of the people in law school, because of lawsuits and legal challenges. So all of those parts of that closing are opportunities for something to go wrong. So settlement is still a really big source of loss for us. This is a graphic by the American Land Title Association, and I just liked it because I thought it was a good illustration of what we do. So obviously, they're saying, think about title insurance as a force field against all these potential risks. You know, misinterpretation of wills, lack of right of access, inaccurate surveys. What our industry has had, I think, is suffers kind of from being unknown. So people just think that they sign on the closing. It's a money amount that they get mad at. They feel like they shouldn't have to pay it. They don't know why they have to pay it. And we are now trying to educate consumers about why it's important because, like I told you about the people who didn't get the owner's policy, that would have cost them. In Florida, our rates are set by the state. It's promulgated. So it's a little tiered, but basically $100,000 of insurance costs $575. Of the $575, 30% goes to the underwriter for the risk we assume. The rest goes to the title company or law firm for the settlement part of the transaction that they're taking care of. So For them to get another $250,000 of coverage on that property would have cost them $575, $1,000. So the amount of money that they would have had and the protection that they would have had would have made a huge difference. And obviously, we feel like the onus is on us to let people know what we do. So the other thing is that it's not just the owners or the lenders and the insureds who are receiving positive economic impact from the insured product. Title insurance has uncovered, because of requirements on a commitment to pay off IRS liens, and just so you know, these numbers are probably 3 years old. I don't think American Land Title Association has updated them. So when they were looking, let's say in 2013, we had collected $1.7 billion in delinquent IRS liens as an industry. We had collected $3 billion in delinquent real estate taxes. Because what happens is when the requirement says we are not going to insure that property until you take care of this or this or this, then the title company or law firm has to collect it. And then the IRS gets paid and the real estate taxes get paid. $325 million in delinquent child support. Nobody thinks about that. That's a huge benefit of this part of the research. $225 million correcting public records. So because we have human error, and because we have Dave also in the recorder's office recording documents and taking care of things in the public recorder's office, there's mistakes. Also because of our people, they're preparing documents and recording things. There's a lot of mistakes. We end up fixing those as we go down the road, so that's $225 million spent by our industry correcting the public records. And then we are the biggest customer of the county recorder's office. We've spent, we're 17% of most of their budgets, $170 million purchasing documents from them. So, you know, we generate a lot of economic revenue and impact by purchasing those public documents. So I'd like to think that everybody here is really all geeked up about title insurance and excited about it, but I figured that I would switch gears a little bit and talk more about what I do and my job, because you're probably more likely to end up in a role like I have than necessarily in the title insurance industry. So I am, as you heard, I am the Senior Vice President with the Florida Operations. I actually co-manage the whole state. And I'm primarily day-to-day responsible for Central Florida, but I have a counterpart to the north and a counterpart to the south, and we manage the statewide operations. You guys are probably more likely to end up in whatever job you do as a manager, I would think, in the future. And so I'm going to talk a little bit about some things that I've learned as a manager. I am by no means perfect, and I can tell you that I learned from I learned from people who do it very well all the time, and I also learned from people who are bad managers. We've had some recruiting opportunities lately from some people who I think got it wrong on the management side. So those are lessons I take internally and try to modify my behavior as a manager. Something that somebody said to me maybe a year ago that I thought, gosh, I really want to remember that, because I think it's super important, is to lead with a tough skin and a tender heart. And the reason that I bring that up is because I was a peer to most of the people now in our company that I manage, or to a lot of them. And so it's very hard when you're like this, and then all of a sudden you're managing and you're managing them when you used to be lateral. What I learned with this is that I had to stop worrying about what everybody thought, and I had to kind of get over that, but I had to be compassionate, empathetic, and fair. And once I found that balance in my own personal world, I think people came around and we ended up with a better working relationship. But I am, and I'll talk about this in a little bit, I'm constantly worried about the work environment, because we have a very competitive industry in Florida and people are always trying to take your talent. And somebody can always walk in and write a big check on any given day. And so we have to build a place that's hard to leave for more than money. So I take it very seriously. So that's kind of what I try to remember behind the scenes. This advice, this was something that I heard probably 30 years ago. And I bet you I use this every single day. I was at a conference in Nashville where the speaker was talking about being on a big blank stage, and he said, imagine there's a pole in the middle of the stage, like a fireman's pole. And he said, you see it, and you think, what's that doing over there? You walk over to the pole, and you're thinking, I don't know why it would be here. And you notice that it's shaking. He said, so you go, well, that's weird. Why is it shaking like that? So you touch the pole. And he said, then all of a sudden, you're going like this, and the pole's going like this. And you're thinking, I don't like this shaking. I don't want to shake like this. Let go of the vibrating pole. And when he said that, to me, the visual of that vibrating pole, and it stuck with me. And I can tell you, where I sit in my office, I can see people coming toward me all the time. I can tell by the way they walk. I can tell by the sound of their feet if they're stomping. I can tell by their body language if they're going to come in my office and drop something and then feel better because they dropped whatever problem and then they run out and leave. And so I had to start realizing that I had to take a deep breath, realize that they weren't going to come in and vibrate and I was going to vibrate too, and we were both going to be like this. That I was going to be calm, I was going to be a resource, I was going to be a problem solver, but I was not going to vibrate with them. So I can tell you this works with children. How many people in here have children? Somebody had twins. Who's the one who just had twins? You do? Okay. You really need to write this down. You will really use this. This is just one of those things, and I can tell you it's in the checkout line at the grocery store. It's in your personal life. This, once you realize that all you have to do is do that, and then you get the control back on your side, it really can change the dynamic of a moment. So I'm going to briefly talk about the 3 most important things that I can do as a manager, and hopefully if you guys end up in management, you'll learn just a few things from me. But like I said, I'm learning every day too. So I talked about culture. I think it's the number one thing is not profits, not making money. It's not getting promoted. It's not anything else. In my mind, in our company, it's driving the culture. And again, because you have to develop a place that is hard for people to leave. So when I talk about the culture, we've had, in 2010, we came together with all those companies that you mentioned. And it was very hard because we had sister companies, so we had competitors all coming together under the same roof. So while you were a sister company, not everybody likes their sisters. So it wasn't necessarily the best environment when we all came together. And so the market, fortunately, was really bad at the time, whether it was by design or we were just fortunate enough to have that happen. The good thing about that meant that people didn't have a lot of places to go. So they had to stick it out and they had to see where we were going. What started to happen was people would sit next to each other. We mixed everybody up. They'd sit next to each other, and they'd start talking to somebody and realize you're great at meets and bounds legal descriptions. You're great at mechanics liens or probate. And they started finding reasons to respect each other across the aisle. That respect translated to a rise in our culture, a positive impact. We ended up, the market came back, we started losing some people, and we had a competitor across the street, and we lost 3 people in like 2 months, which normally would make me crazy, because I want to keep the team that we have and add talented people to it. So I was talking to somebody from that competitor who said, I can't believe we've hired 3 people from you. It's insane. And I said, and you know what? You've got 1 more to go. And he didn't understand what I meant, but what I meant is we had some Eeyores in our operation who were not evolving with this change in our structure. And we had 1 more, in my opinion, before we could finally have a culture that was going the direction and people that were going the direction we wanted. So as important as it is to make it a great place to work, there are people who don't belong, and that's okay. And so when they were opting themselves out, that was good for everybody. So I'd say that. So I'm going to show you some silly pictures, just because the other thing is title insurance is extremely fun, but you're supposed to laugh right there. But we do a lot of things on top of it to add to the fun. So we're always trying to do stuff for our customers and for our employees to remind ourselves that it's not brain surgery and no one's going to die on the table if we miss something. So this was a picture from, and I don't know if anybody knows Princess Beatrice or Eugenie, that hat she wore to the royal wedding. So that's a hat that I got for Halloween so I could dress as her for Halloween, and then we did a Kentucky Derby seminar, and so I got to wear the hat again, so I was all excited. Just some other events and pictures I put up here. This is a bowling event we did for all our customers where we got them out. Again, because you need your key people to meet their key people. And it happens in the transactions every day, but I'm telling you what, if they bowl together, it's a different relationship. If they go, you invite them out to happy hour together, it's all about, I know you better than I know you. And so you have to make those opportunities for people to get to know each other. This was just an event where we just did a Family Feud show in an office where we brought a bunch of people together who didn't know each other, put them on mixed-up teams, and did a game show just to get them to kind of get used to each other. This one I just threw in. This was the Kentucky Derby again, and our reception group put horse heads on, and we didn't know they were going to do it. It was kind of funny. And then this was a chili cook-off. We do a chili cook-off in a lot of our offices, and we invite our staff to make chili and our customers. And our customers have become very invested in getting the cook-off trophy. So we'll have, this one was in Maitland, we'll have 20 chilies. And I'm telling you, when a customer comes in at 10 o'clock in the morning with their crock pot to enter the chili cook-off contest, it's a very powerful thing, because that is outside if they're an attorney with billable hours, that's time out of their day to do that. So again, finding ways to connect. This last picture is just, these are some of our best speakers. You can't tell that from the picture. But that was when we did something that was school-related, high school-related. So the next thing, the most important thing that I do in a management job is recruit talent. We've had an unprecedented opportunity for our company in the last 6 months. I think I talked to you about a competitor that's going through some anxiety. So we have recruited from that company, 6 people in the last probably 4 months. 3 of their state managers. And what's super, super important, and I'm sure in all the industries you guys are going to be in, is they're really small. So the title insurance industry is actually a small community, even if you look in the whole country. The same things that you guys are doing. So you are always meeting your next possible employee or your next possible employer. And so we had all these people we had good relationships with. We just stayed in touch with in a casual way. And the other company made a management decision that has not turned out to be very good for them. And once someone made the switch and said, you're not going to believe what it's like, you know, because then we had an advocate. You should come here to his peers. Now we actually have a spreadsheet and more people who want to come than we feel like we could even take on. So just in my management role, just want you guys to think about that. Recruiting talent isn't about the opportunity in front of you right this second. It's about the opportunity 2 years down the road, 5 years down the road. And if people know you or your company as a great place to be or a fair-minded person, when something happens in the other world, the opportunity is going to present itself. The third most important thing for me to do in my world is protect the margins. And so what that means is, so I said I co-manage the state. We just did our budgets this week in Atlanta. The state of Florida for Fidelity is projecting to do $40 million net revenue to the company. We did, back in probably 2009, $6 million. That's an incredible increase. $6 million was not good. What we're always responsible for, no matter what the market is to adjust our expenses to keep the profitability up. So it's just like in your home checkbook. It doesn't matter if you make $100 or you make $100,000. You still have to be able to pay your bills. You have to be able to put some money in the bank account so that you are not stuck and living paycheck to paycheck. We have to do the same thing. And so when I talked about culture and recruiting, if we get those things right, this takes care of itself. Because we end up with the momentum and the opportunity in the company to build revenue and offset the expenses. This is just an example just about Central. And you're always competing with yourself. So in Central, this is through October of 2017. So in Central, in 2016, we were at 9.89 million, so just under $10 million through October in just Central, and then a 30.2% margin. In 2017, so year over year, up to 10.8 in earnings, but the margin, again. So what you're doing is you're spending less to make more money. And that, again, is as an insurer, we have to do that. As a manager, we have to do that. As an employee in a company, we have to do that. It's really important. And the other thing I would say, I probably meant to say this earlier, I think what it behooves us all to do is to think about who you are as an employee. Doesn't matter where you are in the organization. Are you an Eeyore? And I say that with the nicest intent, but there are opportunities to stir the pot in companies, and there are opportunities to provide solutions and be a person who delivers value. And on any given day, any one of us can be any of those things. But I can tell you from the standpoint of trying to manage and move a ship, I'd much rather have the solution finders than the pot stirrers. And eventually you figure out what's going on and where it's coming from, and then have to make changes. So our biggest challenge as an industry, as a title industry, is the pace of disruption and corruption. And I say this because we have, obviously, there's a lot of criminals attacking escrow accounts and banking. But the other thing that's happening is everything that we are asked to do, we're asked to do faster and faster and faster and faster, which leaves us more time for mistakes. And when I was in Montana, our IT guy showed a slide that actually gave me goosebumps because I thought, that's mind-blowing. And I put it in here because I think you'll feel the same way about it. And what it's really, it's again, it's pace. So the pace of change is changing every business in the real estate world. So this was about the time it took an industry to reach 50 million users. So it took radio 38 years to get 50 million listeners. It took television 13 years to get 50 million viewers. It took the internet 4 years to get 50 million users. Facebook 3.5 years. Twitter 9 months. Instagram 6 months. And Pokemon Go 19 days. So when you see that, I mean, if you're like me, I still get chills every time I see that slide, because that's what we're facing. Every single thing we do, the expectation is faster, now, more. I always said in the title industry, I wish I could go back to say the horse left with it 10 days ago, and then you'll get your documents in 3 months. The fax machine was what I was kind of railing about when I said that, because the fax machine was no fax it to me now. And that's so old school now. It's really now an instant. So I share this slide with you because I think it provokes the same kind of a feeling in me that the pace is what's going to be our biggest challenge.